India's market news headquarters. Cutting-edge analysis. Influential insights. Market-moving intelligence. Broadcasting live from the CNBC-TV18 Motilal Oswal studios in Mumbai.
Good morning, hello, and welcome to a brand new week and a brand new edition of Bazaar Morning Call. We're coming to you as always live from the CNBC-TV18 Motilal Oswal studios. I'm Surabhi Upadhyay, back with the first day of the new year in terms of back in the studios with my friends and co-hosts Nigel D'Souza and Rima Tendulkar. Let me start by wishing both of you a very, very happy new year, guys.
Well, happy new year, Surabhi, and welcome back. And I'll tell you what, it's happy new year to a lot of people out there, because last week I don't think too many people were tuned in. So a lot of people getting back to work. A very, very happy new year. Let's hope 2025 is better than 2024.
And we're kick-starting with so much news flow, right?
Yeah.
In terms of the business updates from banks, the consumer stocks. Now that Surabhi is back, things are going to be in action.
Well, I think the action was happening even while I was away, guys, because I was watching that FII number very carefully, even while I was away from the market, just because it kept making headlines. We were hoping for that FII selling to ebb, but I don't think that's exactly what transpired last week. So let's quickly start looking at the cues. The good thing is that we've managed to see a positive close on Wall Street. So Friday was fairly okay. After a shaky start, the indices across the board, S&P 500, the Dow, the Nasdaq, all of them put on gains between about 0.8% to all the way up to 1.8% of the Nasdaq. The tech pack was really fired up in US trading on Friday. So that's one. The data point that came out was on the manufacturing front. So we had the December US ISM manufacturing number come in, and that number is creeping back towards the 50 mark, which basically tells you that the economy or the manufacturing sector is expanding once again. The number came in at about 49.3 in December, which was higher than estimates. And what did that do? Not only did that sort of give a leg up to the equity market sentiment, but once again, we've been talking about the rise in the dollar and the rise in yields, and that continued on Friday as well. In fact, if you're talking about US yields, I mean, largely speaking, they have been elevated through the last week, including on Friday, 4.6% thereabout on the US 10-year. And the dollar index is still hovering around the 109 level. I mean, those historic moves that we've seen last week, all put together, the DXY was up almost 1%. And even this morning, it's managing a move around the 109 handle, which has been the big story, which has been driving markets around the world, not just the US. We'll watch out for how that plays out as well. Talking about some of the cues this week, I mean, it's going to be all about this all-important jobs report, which comes out on Friday. That's going to be setting the chain of events in motion. In the anticipation, of course, we'll watch out for more announcements and, of course, more social media posts coming in from either Donald Trump or Mr. Musk, which has happened over the weekend as well. What also happened over the weekend, just to put the global picture in context, was China, particularly the PBOC, the Chinese Central Bank, wrapped up a two-day meeting, and on Saturday, the highlight was the PBOC committing to what should be a moderately loose monetary policy for 2025. Now, there were no specific indications of how many rate cuts and when, but the idea was that the PBOC is going to be largely supportive. So let's watch for the China piece as well. Now, coming to the point that I was talking about, all through last week, if you thought that at least the end of the year phenomena is going to keep the FII selling at bay, that did not happen. Just look at the bars, look at the numbers. And then Friday was the biggest one. Again, selling of over 4,000 crores coming in. To some extent, it was masked by the domestic buying, but it wasn't enough. And this is something that's going to be the biggest watch point as we talk about it. The FPI exodus is having its impact on the currency as well, coupled with the fact that the dollar is very, very strong in the international market. So watch out for this. The rupee has been racing towards the 86 mark. And if you look at the forex flow picture that we got on Friday, given that the fact that the RBI has been in the forex markets, off and on, our forex reserves also depleted by about 4 billion, give or take. So the rupee picture continues to be extremely important. Now, for the market, 1% rise overall for the Nifty last week. But the question is, can the Nifty see any kind of a rise in the face of this kind of FPI selling? It's been testing the 20 DMA and the 50 DMA. Friday, the close wasn't above these levels. So let's see how it plays out from here on. And I would say the key question for me is, can earnings, the FPIs will do what they do, but can earnings provide any kind of a support? I know Rima is going to kickstart the season with TCS. But ahead of the earnings, we got a lot of corporate commentary, and we'll talk about it as we go forward from banks, from consumer companies. But on consumer, folks, what I noted was that it's still a very, very mixed picture. Dabur is still very worried about what's happening with the general trade channel. They're still very, very cautious, talking about single-digit growth. But there are others like Marico that saying that double-digit growth is going to happen in the third quarter. So I think the commentary from consumer is very mixed. Banking is lots of updates. But really, I guess the question is going to be, can domestic earnings in the third quarter provide a little more hope and optimism compared to what we had from earnings in the second quarter?
Well, watch for HDFC Bank, right? That's the biggest contributor, and it was the biggest drag on Friday, 2.5% lower for the stock price, and the advances growth was very anemic. That said, the deposits growth picked up to about 16% on a year-on-year basis, so that was a positive, but the street will be a bit worried about the fact that the advances growth has been just tepid at close to about 3%. So that's going to be an important stock. In fact, lots of heavyweights, right? Kotak Mahindra Bank, ITC, and so many other financial stock updates, whether it's from Bajaj Finance, IndusInd Bank, Bandhan, RBL, L&T Finance, Bank of India. We'll talk more about it. In terms of the key data this week, remember the NYSE will be shut on Thursday to mourn the death of the former President Jimmy Carter. So it's going to be a holiday truncated week for the US markets this week. On Wednesday, you've got the ADP employment report. On Thursday, the FOMC minutes for the December meeting and the JOLTS data. And Friday, the all-important non-farm payroll data. On Friday, the markets closed lower, closer to the 24,000 mark. Thursday was a strong session for our markets, but on Friday, the markets pulled back and gave up close to about 0.7%. Some of the key markers to watch. So last week, the intraday low was 23,460 and the intraday high was 24,226. So just in the immediate term, watch for 24,460 going up to 24,300. And as long as the Nifty holds on to the 200-day moving average, which is 23,900, as it did on Friday's, as per Friday's close, I think the bulls will try to push higher and higher through the course of the week. But depends on the earnings and the headlines that we get on that front.
Well, that's right. You know what's positive from the US market perspective is at least it ended in the green. And the other positive was the dollar index cooled off a little bit from the top. I'll tell you what, the bulls will be very, very happy looking at that because the dollar index was going out of whack towards that 110 odd mark. So cooling off is good news. What did the FIs do though? As you all said, yes, they sold in the cash market and they added all the shots that they unwound or they covered in the previous trading session. So there was a big short addition of more than 20,000 contracts on index futures and some mild unwinding of long positions. So how do the things stack now? The FIs and the clients, they're on opposite ends of the spectrum. The FI is net short with 83% of their positioning on the short side, with the absolute number at around 2.3 lakh contracts on the short side. Clients, they are net long with close to around 70% of their positions on the long side, and that number is roughly around 2.5 lakh contracts, and both of them have moved to the opposite ends of the spectrum. Two strikes were fairly active. 24,100 call, well, that was fairly active in Friday's trading session. 40 lakh shares getting added there. And on the downside, you look at the 23,700 put that was fairly active. Plugging in the numbers and going by the technical levels as well, the 24,200 mark becomes the near-term resistance. Why do I say that? Because the 20 and the 50 DMA are in that vicinity of around 24,150. And we did a U-turn from around 24,200. So that's the near-term resistance that we're looking at. Going by the options data, that becomes the near-term support because the 23,700 put was active, premium roughly around 50 rupees. So that's the level to track on the downside. Well, the swing factor of the day is going to be HDFC Bank. The stock has gone weak into this operational update and it seems the street was sensing something. I won't be surprised if, the stock opens up a little bit softish. It moves up, and this will actually be the trend for the day. This one, the way it moves, that's going to send the note for the remaining of the day because the street clearly was factoring in some kind of weakness, and it appears, at least with regard to this operational update, the weakness could be in the price if it opens up a little bit lower. The Nifty Bank as well, very, very important market is what it is at. It closed closer around that 51,000 odd mark. On the upside, you're looking at the 100 DMA, which is a little bit away, but the 200 DMA is around 300 points away from current levels. So that's the crucial zone that you're looking at for the Nifty Bank. Finally, another stock that I'm going to be looking at is Crompton Consumer Electricals. The stock has seen a very, very sharp correction in the last 1 month itself. It's down close to around 10%. But there was big delivery-based action in Friday's trading session. 25 lakh shares got delivered. That compares with an average of around 6 to around 7 lakh shares. So the fall was only around 2% on Friday, and big delivery-based action is what we saw. Let's see whether or not it's forming some kind of bottoming out process because it's been a big underperformer just in the last 1 month or so. So I'll keep an eye out on this stock. It's moved to around 365 rupees odd. Stock to track.
Thank you very much for that. Rajiv Agrawal, Managing Partner and Fund Manager at Doordarshi India Fund, is now joining us on the show. Rajiv, thank you very much for joining in. You were a bit cautious on India. You were contemplating taking, cash out of the markets, and since then we've seen the markets correct close to about 10% and not quite recover from there. So what have you done in terms of your portfolio in India for the last 3 months, and what's the outlook over the next 3?
Actually, that's a very good point you raise. We are quite bullish now on India. I think given what has happened in Q2, where the GDP slowed down, we think that the GDP will start picking up back. And some of the sectors in India that were underperforming will also start doing well, especially on the CapEx and the infrastructure side. So we are actually now deploying cash, and we are seeing some good opportunities, especially as the market has pulled back.
Deploying cash?
Yes.
Do you want to talk to us about the opportunities? Where exactly are you putting your money to work?
Sure. No, so I think one of the sectors we have been a bit excited about has been the banking and finance space. And especially what has happened is with the MFI performance in Q1, Q2, which was very, very weak, there is this narrative that this particular weakness will continue. We do think that the rest of the year would be a little bit muted, but going into 26, financial year 26 and 27, we think that will be a good area for growth. We also think that some of the big banks actually have been beaten up because there is this concern around RBI reducing the rates going forward. So we think, again, that is an area that should do well, because ultimately, as the capex comes back, both from the government and the private sector, I think that will help the banking sector to increase its book, and through that, be able to make more returns for the shareholders.
Rajiv, hi, good morning and Happy New Year to you. So yes, I mean, I think that the interesting facet is that this week or this year has started with investors slightly tempering their expectations from the market. At least that's what all the wise men on the street have been telling us, right? You've been favoring BFSI for a while now, but what else? Since you are now willing to deploy cash, where else is the money going in India?
Yeah, I mean, I think the biggest opportunities we are seeing is in the banking and finance. But beyond that, I think even real estate, there has been some pullback. We think real estate cycle is still in the early to medium stage, and I think there is some good opportunity there. You are seeing in certain pockets a lot of excitement there. So real estate is another interesting area. I think renewable energy, I have talked on your show in the past. We think renewable energy right now is very, very cost competitive versus the traditional form of power generation. And India has some big, bold goals out there for 2030. So we think that momentum will continue. And then, the capital markets remains to be seen, given what has happened with the whole futures and options constraints that SEBI has put in. We will see how the Q3 numbers look. But those are some of the segments that we are liking, which is banking and finance, real estate, renewable energy are the primary ones.
All right. Hi, Rajiv. Good morning. Good to see you in. Wishing you a happy new year and looking forward to your inputs all through the year. But Rajiv, let's, get a little bit stock specific if you could give us some color. In the past, you've named a few stocks. Manappuram is a stock that you've spoken about, some of those private sector banks as well. So from both these themes or all the three themes, if you could give us at least a name, banking and financial, the real estate basket, as well as the renewable energy space. What do you like? Stock specific.
Sure. So, I mean, just before I give the names, as you know, usual disclaimer, we own most of the stocks that I will mention, so we are clearly biased, not a recommendation, right? So I think in the banking and finance, Manappuram is something we have talked about. We think you might have seen in Manappuram case, one of its subsidiary went under constraints from RBI, where 4 of the NBFCs were put under constraint for disbursing any loans. 2 of them have actually come out. So I think that is one of the reasons possibly why Manappuram has been rising, because 2 of the 4 are no more under the constraint. And there is expectation that possibly even Ashirwad will, over the next few months, come out of that constraint. Beyond that, I think even we have talked about IIFL Finance in NBFC space. We think IIFL Finance, if you looked at the Q3 numbers, the gold loan numbers of IIFL Finance in Q3, which they put in their presentation recently, very strong gold loan growth. So we think IIFL Finance should be another interesting opportunity for the long term. Beyond banking and finance, if we go to renewable energy, I think the name that we own is Inox Wind, and we own that through Inox Wind Energy Limited, which is a holding company. We think, again, Inox Wind in the India's renewable energy space, especially the wind turbine space, there are two main players, Suzlon and Inox Wind. And then we think both of them have a big, wide opportunity to continue to grow. They have done well in 24, and we expect that given the opportunities they are seeing in this space, where the rates for generating new wind power is pretty competitive to the traditional rates, we think that they should continue to do well. And then on the real estate side, sorry, you have a question, Nigel?
No.
Go on. Yeah, real estate, the
we want to
names.
hear the real estate name. So we've got from renewables, you said Inox Wind Energy, right?
Yeah.
That's right.
And Suzlon.
Yeah.
Let's hear the real estate pick then.
Yeah, on the real estate side, I think we have been much more bullish on the Mumbai MMR space, and I think that is one area where we have looked at Sunteck in the past. And Sunteck, right now we are basically holding, but I think Sunteck is a stock which also now is having some property in Dubai, and they have some good properties that they're developing in the MMR region. So we think that could be an interesting space to look at. Clearly, these are things that we have held for multiple quarters now, so not necessarily a recent buy.
Okay, so lots of interesting anecdotes and ideas there, BFSI, real estate and renewable energy. Rajiv, to sort of round up the picture, sort of pull back, zoom out and go global once again, because it's all about the 20th of January and what actual real policy announcements will come in from President Trump, right? But even as we, move up to the event, the fact is that India has been hit hard by this rising dollar strength, by the fact that, FPIs are continuing to press the sell button, including the last week of the year. What do you make of this? And on a slightly more macro level, how do you think, India will sort of deal with these dynamics, this FPI selling that now has been on for 3 months?
Yeah, so actually, we have a contrarian view there. I think the US equities have done very well in the last 2 years. And therefore, a lot of the positives are already in the price. We think US equities, people are too sanguine about what Trump will do. We think that a lot of those are already in the price. So we would expect that 2025 will be a little bit more muted in terms of returns than what the street is expecting. As that happens, we think that the power of Indian equities and the growth that we have in India will start becoming more prominent. And so there will be a reversal of this flow that we have seen in the last few months. The second thing is that we have seen that Chinese yuan has also been depreciating. So I think the Indian rupee and the Chinese yuan will continue to be moving close to each other, because clearly there is a lot of areas where there is parity that needs to happen. So if Chinese yuan continues to depreciate, we think Indian rupee will also depreciate. But irrespective of that, I think the exports should pick up over time. And we think that Indian equities from current pricing should actually give better results or returns in 2025 as compared to where the US stocks look right now.
Rajiv, great conversation. Thank you very much for joining us on the show this morning. And now let's move on and tell our viewers the corporate interactions we've lined up. So first up at 8:35, Nishant Pitti, former CEO of Easy Trip Planners, will join in to discuss his resignation and the decision to sell 1.4% stake in the company. 9 a.m., we've got Abneesh Roy of Nuvama Institutional Equities to talk about the ITC Hotels demerger and the various consumer business updates coming through from Marico Dabur. 9:20, Devina Mehra of First Global will be our market master for the day. 9:30, the management of Rainbow Children's Medicare will talk about the H2 outlook. Following that, Anand Agarwal of V-Mart Retail will be chatting with us at 9:40 to discuss their Q3 business update. 9:50, Rahul Sharma of JM Financial Services will join in to decode charts and the technical trends in the market and several counters. And finally, end of the show, it's our special segment, It's the Economy. Lata will be in conversation with Shantanu Chakraborty of BNP Paribas to discuss what the early advance deposit growth data indicate about the Q3 performance for banks.
Well, time to slip into a short break, but we have a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, we're running through the list. HDFC Bank, Bajaj Finance, Nykaa, they'll be reacting to positive news flow. On the flip side, Kotak Mahindra Bank, JSW Energy, IndusInd Bank, RBL Bank, L&T Finance, Bazaar and Marico will all be reacting to negative news flow. Slip into that break, come back, we'll get into all these stocks in greater detail.
Welcome back. You're watching Bazaar Morning Call, and these are the top stocks to watch this Monday morning. Our research team is standing by. Abhishek, first up, it's HDFC Bank and Kotak Mahindra Bank that everyone will be watching. Good morning.
Good morning, Rima. So to begin with, deposit momentum for Kotak Mahindra Bank has been better than industry average, growing at nearly 16% YOY and 2.5% quarter-on-quarter. Management has been highlighting that they intend to bring down the CD ratio, and that is why they are giving up on loan book and selling down the portfolio, which has led to advances growth being just 3% YOY and about 0.9% sequentially. But credit deposit ratio continues to decline now, which is in line with what they have been guiding as well. Kotak Mahindra Bank now 8 to 9 months post the RBI ban on their various digital platforms. Their CEO and CTO has resigned, which raises concerns with respect to top management churn over there. Milind Nagnur has resigned as the CEO and CTO of the bank with effect from 15 Feb 2025. Back to you.
Okay, all right, got that. Abhishek, thanks very much for that. Let's move on to Vivek, who's tracking some news flow on JSW Energy this morning. Vivek, morning, what's up?
Well, good morning. That's right. A slightly concerning development as far as the entire power sector is concerned. Now, what's actually happened is that the Center for Electricity and Regulatory Commission, that is the CERC, which was supposed to go ahead and approve a tariff for a project. This is a BESS project, a battery energy storage system project. This particular project was won by JSW Energy's renewable energy arm, and this was a project won from the SECI, that is the Solar Energy Corporation of India. The project was a 500 megawatt that was supposed to give close to 1,000 megawatt hour standalone BESS project, and CESC has not approved the tariff for this particular project that the company had won via the auction or the bidding process. This was done in 2023. CERC says that the main reason that they've cited is that the discovered tariffs in subsequent auctions for other projects are actually lower than the tariff that was discovered in this particular project. And along with that, CERC has also cited delays that SECI has done in terms of going ahead and signing both the supply agreements as well as the power purchase agreements for this particular project. JSW Energy says that they will go ahead and appeal this particular verdict from CERC. Expect a red as far as JSW Energy is concerned today.
Thanks for that, Vivek. Let's go back to Abhishek. Abhishek, some more banking updates you want to give us?
21 lenders came out with their update, Nigel, over the weekend. So let's begin with Bajaj Finance. The new loans have grown by 24.5% sequentially, which has aided the AUM growth. Now, AUM growth may look at 7-quarter low, but take no away from the fact that it's grown at 28% YOY and about 6.5% sequentially. The cross-sell rate has also improved on a sequential basis. Now, our IndusInd Bank, their deposit momentum has been slowing down. YOY, the growth of 11% is perhaps one of the weakest in last 16 quarters, and for the first time in last 19 quarters, you are looking at deposits declining for them on a sequential basis, and this has impacted their loan growth as well. Loan growth has come in at 12.3% YOY, one of the weakest that you are seeing in last 12 quarters, and sequential growth is at 2.8% quarter-on-quarter, one of the best in last 3 quarters, but a small number. RBL Bank, the deposit momentum has slowed down to 15% YOY, and it has declined by 1.1% sequentially, the 9-quarter low with respect to deposit momentum for them. Advances growth on account of low deposit flow is at 13.3% YOY and 3.3% sequentially. It's at 5-quarter low. Now, L&T Finance, the rural business has taken a huge knock over there. The rural business finance disbursements are down 16% YOY and about 15% sequentially. This has meant that the retail disbursements are up just 4.5% YOY and about 0.7% sequentially. Remember that they have been focusing on the retail business over the last few quarters, and this number looks to be on the weaker side. Back to you.
Thank you very much for that. On Bajaj Finance, I think there is a Nomura upgrade which has come through post the Q3 update. But it's over now to Mangalam for the latest on Bazaar and Marico and what the Q3 trends suggest.
Well, if you look at Dabur and Marico, the trend suggests that there has been softness in their update coming in. For Dabur, they've said that while rural consumption is resilient, general trade is still under pressure. So as a result of which, consolidated revenue expected to grow in low single digits, much below what the analysts were anticipating. Beverages reported a muted performance. That's uncharacteristic of the third quarter, where typically you see good performance coming in out there. Healthcare has been impacted by delayed winter, and the company expects, flattish operating margin growth as well. So see red on Dabur. On the other hand, for Marico, the consolidated business has reported mid-teen revenue growth year on year, but it is higher than expected inflation in copra and vegetable oils that have impacted gross margins. So they expect moderate operating profit growth this time around. Revenue growth is strong for Marico, but margins may compress, going with mild green for Marico and red for Dabur.
Okay, so some green for Marico and some red for Dabur. What about Nykaa, Manglam? Looking pretty or not?
Bright pink, I would say, if I could, but it's green right now. We had Anchit join us on the channel on Friday as well, spoke about the underlying trends in the beauty segment, and that's something that's reflecting in their business as well. Net revenue growth likely to be higher than mid-20s in a segment which is poised for growth, and beauty vertical itself has accelerated, growing in above mid-20s, and the gross merchandise value out there growing upwards of 30% as well. So that's a positive. Fashion business, it's subdued, but still will grow net revenue over 20%. So see green on Nykaa.
All right, Mangalam, stocks aside, wishing you and Sonal all the very best as you all welcome baby Vani. Pink is the color, brother, that you're going to be going with, and that look that little baby is going to give you is going to be the look that no one ever gave you in your life, and the warmth when she holds your hand as well. Wishing both of you all the best and welcoming baby Vani as well, Mangalam. Best times for you await.
Thank you so much for your wishes, advice, blessings and all of that. I'm sure you guys will keep peppering us with experience and a lot of advice as well. Last 15 days, they've been a joy and we're very excited for the lifetime ahead.
Lots of love, Mangalam. Thanks a lot for running us through all of the stocks. And thanks, guys, for running us through the entire top 10 segment. Well, let's run you through the entire list. Stocks with positive news flow include HDFC Bank, Bajaj Finance, Nykaa, as well as Marico. Stocks with negative news flow, Kotak Mahindra Bank, GSW Energy, IndusInd, RBL Bank, L&T Finance, as well as Dabur.
Now let's get in a handle of what's happening in the commodity and currency space. Manisha Gupta joins in as always. Good morning.
Morning, and thank you so much for that. Well, I'll start with the crude oil prices because we've seen already a gain of 4% since the time 2025 began. So prices for crude is trading at a 2-month highs. Well, 3 or 4 factors which really seem to be supportive. One, you have cold weather in US and Europe, so the demand for crude products is on the higher side. Second, the markets are anticipating China economic stimulus measures to come in more stronger this year. That sentiment is keeping the prices higher. And this is happening even as the dollar index is trading at 109. And that should be putting pressure on prices. But as of now, it isn't. The third thing really is about the decline in U.S. crude inventories for the last 3 weeks now. And that has been supportive. And then it's going to be about geopolitics as well. Markets do believe that Iran could be looking at some more sanctions from U.S. going forward. Russia already has halted gas pipeline exports through Ukraine. So those are the factors supporting crude oil prices right now. But within metal as a sector, we've also seen copper prices gain up back above $4 a pound. So that is a multi-week highs coming in for this one as well. There is buying interest, especially after copper prices fell by 10% in the previous quarter. So a couple of these things have started Asia on a very positive note.
Okay, all right, Manisha, thank you very much for a roundup. With that, we do have to take a very quick break. On the other side, we will connect with Prakash Diwan. He will weigh in on the fundamental ideas and cues that we have today. Back with that in just a bit.
Welcome back. You're tuned into Bazaar Morning Call and hope you're having a good morning. Well, let's focus on the other big news point today. Today marks a record date for ITC Hotels demerger. The restructuring will see ITC retain close to 40% in the hotel business, while 60% will be held by shareholders. Mangalam's here to break all of that down for us. Mangalam, over to you.
Well, it was in July 2023 where ITC first announced this alternate structure. So after a long drawn process, today is finally the record date for ITC Hotels demerger. ITC in July 2023 announced an alternative structure for the hotel business wherein the company would own 40% in the business by itself and the remaining 60% would be held by shareholders via an entitlement swap for which each shareholder will get one ITC hotel share for every 10 shares that they hold. The ITC hotel business, does it list today? No, that lists in mid-February. But today, ITC will go X the hotel business. Of its total business, the hotel business has 4% revenue, 2.5% EBIT, but more importantly, 14% of assets, which makes this demerger ROCE accretive for the parent company, which will be listed today. For the resultant company, that is ITC Hotels, currently has 140 hotels, around 13,000 keys, 55% properties are managed with 69% occupancy. The important part is their stated target, 200 plus hotels with 18,000 keys by 2030, with 65% salience coming in from the managed portfolio. ITC Hotel financials reflect the underlying improvement in the hotel industry as well. Post-pandemic, over the last few years, we've seen growth. And in the first half of this year itself, ITC Hotels revenue has been around 1,500 crores with operating margins of around 28%. Remember, in the hotel business, we have the second half, which is more margin accretive than the first half itself. If you look at the balance sheet and the opportunity as well for ITC hotel business, remember 52% of the business revenue comes in from rooms, 40% from F&B. There's a strong opportunity in the hotel business with zero debt, cash balance of 1,500 crores, and only 20% of their inventory is currently operating at 75% of potential occupancy. So that is telling you that there is room for operating leverage as well. They're also looking at value accretive M&A and alliances. The big question, how do you value this business, right? So for that, you have to look at projections. Given the recent history and the numbers that we have, FY25 could be close to 3,700 crores in revenues, FY26 4,400 crores with EBITDA of close to around 1,500 crores itself. And if you look at all the other listed hotel companies right now and their multiples, Indian Hotels is at 37 times, Chalet Hotels 25 times, the others between 17 and 18. My guess is ITC would settle between 25 and 37, closer to 26 and 28. And that means a market value of the ITC Hotels business between 36,000 to 39,000 odd crores. But remember, this is the entire hotels business. 40% will be held by ITC, on which a holding company discount would be there. And the remaining 60% could be between 22 to 24,000 crores. What happens to the ITC hotel listing? Whenever that lists, the shares could be worth 175 to 190. But today, the important part is the ITC share could adjust by around 17 to 19 odd rupees as the business goes ex-hotel business.
Okay, all right, Pankaj, now very nicely explained. Thank you very much for telling us how optically, how the ITC share price will reflect the fact that today is the ex date.
And between 9 and 10 a.m., there is going to be a special pre-opening trading session for price discovery. So
absolutely, yeah, and we have some ballpark, estimates to work with in terms of how the market could be valuing the business. And interesting times to list as well. There hasn't, I think, been a better time for the hotels and hospitality sector than in the last couple of months. So the ITC, you must say that overall, if you look at the ITC share price, it hasn't gone anywhere. It's been a very range-bound last 12 months for ITC. Well, let's welcome in Prakash Diwan into the conversation. Prakash, morning and season's greetings. Wish you a very, very happy new year. My first conversation with you in 2025. So let's start right there. ITC, tell us how you look at the rest of the businesses, ex-hotels, and whether you like hotels enough and you think there's enough value unlocking potential, because you need to own the shares today if you want to get, if you want to participate and have the listed hotels business as well.
Yeah, thank you, Surbhi, and best wishes for 2025 to you as well. It's very simple. The ITC stock hasn't gone anywhere, as you rightly said, post the BAT exit. It moved up. It's been steady because everybody's been waiting for this event. This was a critical event in terms of price discovery. If the ITC hotel loses, let's say, $20, that means the hotel business is getting valued at 200. So it's going to be nothing very dramatically different if you already own the ITC limited stock beforehand. But now you have a very clear choice of whether you want to own the fast-moving hotel business or the fast-moving consumer goods sector. Now, so that differentiation means a lot to a lot of people who allocate money. If FMCG is not drawing that kind of capital in recent times because of the slowdown and general tepid performance that you see from the sector, it's probably the hotel business that could fetch a lot of attention. And my sense is that's exactly what will happen once it gets listed and traded in the month of February. But ITC itself, after this demerger, starts getting to use this cash that it generates for growing its other businesses. And some of the FMCG businesses have started maturing quite well. The consumer-facing businesses, the products which they've been recently trying to rebrand and relaunch. My sense is ITC also will benefit. So win-win for both. I don't see there's no preference over one over the other. It's going to be actually beneficial to buy both if you really want to. On the hotel business, I'm very positive. In fact, the likes of Lemon Tree, if you recall about 4 months back, there was this setback that Lemon Tree had in its quarterly earnings saying, they have a lot of money that's been allocated to refurbishment and all of that. And the stock went all the way down to 120 or something, and it's moved back, started moving up. I think it's still a very good buy at these levels given the expansion that it's doing. So it's a great space. ITC will get very good premium valuations eventually, if not today. And that's what we would expect.
All right. Stay on, Prakash. We'll have more questions for you in just a bit, including probably the next company you want to listen to this conversation, Easy Trip Planners, because there's been a lot of chatter about what the promoter intent really is with the Easy Trip Planners. We have Nishant Pithi joining in. Now, we know the developments from last week. Nishant did resign as CEO of the company with immediate effect, citing personal reasons. Rikant Pithi has now replaced Nishant Pithi as the CEO. Nishant is with us on the phone line. Nishant, hi. Thank you so much for taking the call. And I'll just cut to the chase. The market is really wondering what is your intent. I'm looking at the last available public shareholding, where your shares were, your stakeholding was 14.2% roughly. You've sold about 1.4%. I believe you were looking to sell almost the entire stake, but that didn't happen. What is your intent? What are you thinking? And what about the other promoters and the overall promoter shareholding in the company?
Good morning. So firstly, I repeat your question. The decision, the first answer would be the decision reflects in strategic focus on driving growth and expanding EasyMarket's global and international presence in my capacity as chairman of the company. While I continue to play an active role in shaping company's future, Rikant will be taking over as CEO to oversee day-to-day operations and ensure seamless execution to a fair vision. I'm confident that his business acumen and deep expertise in travel industry will pave an exciting and promising future for EasyMarket. And the second question was for selling the stake. The reason to sell a portion of my stake, that is just 1.4% out of 14%, was a strategic step to diversify my personal investment and unlock a value after doing 20 years for EasyMarket. Despite the sale, I still own 12.6% shareholding. And as promoter group, all the three brothers continue to own almost about 50% of the company.
Nishant, weren't you looking to sell a much larger chunk? How much of your shareholding do you want to sell right now?
We are not going to sell anything right now. My focus remains firmly on EasyMarket growth, and I'm fully committed to supporting its expansion and success.
So can you confirm that you, Rikant and Prashant, all of you, which comprise about 50% of the company's shareholding, that neither of you, would be selling any further stake?
Absolutely correct. Moreover, EasyMarket stands out as one of the few new age companies where overall promoter equity remains almost about 50%, which you will not find, in other e-commerce companies.
Mm-hmm. Hi, Nishant. Good morning and good to have you on the show. Nishant, we get that clarification, but the reason you're not selling is because you couldn't find the buyers, right? Otherwise, you were looking to sell 14%.
No, we are not selling.
You had enough buyers, is it?
Yes, we were.
But why didn't you do a strategic sale? You could have reached out, got institutions to participate. We're seeing the institutional shareholding as well as fallen. This could have been handled in a better way. Don't you think so?
It is a better way, but still right now we are not focusing on selling the entire stake. That was being highlighted by the media. And I'm being the chairman of the company. We are just going on global expansions and day-to-day activities, as I mentioned, will be taken care by Rikant. We have a lot of more to deliver on the table.
So you're saying that there was, if you were looking to sell that 14%, the remaining that you had, then there was enough demand, but you have chose that you only wanted to sell this 1.4% and now you'll not sell more. Is that the clarification?
That's correct. That's absolutely correct.
But, don't you think from a shareholder perspective, they're absolutely baffled. You all did so many corporate actions. The retail holding in the, went up. The institutional holding came down. It could have been handled in a much better manner, right? Because suddenly you have so many question marks that are out there. And for a business as you're stating, you're so confident about, it could have been handled a better way. What's your comment on that?
It would be a better way. Now you'll see that we are completely revamping the complete things into the Eastmetric as well. And as I told you, like we are just going ahead with the organic and inorganic growth, both pedals we are scaling it up. So if you see any other companies in new age tech businesses, in particularly in the e-commerce space, you will not find any other company who will be having so much of promoter equity till now. Everybody starts raising the money. We are the first one, like who never raised money, who a bootstrap company went to the IPO. And diluted only 25% the time of IPO, which was mandated to us. We only sold 25% in the last 4 years of listing.
But Nishant, initially, when the block was on sale, it was a 14% block, your entire holding. So what was the intent at that point?
It was not entire holding was on sale. We just sold a part of that. That is
you did sell eventually. Yes, Nishant, you did eventually sell only 1.4 out of the 14%. But when the block was offered to, 10%, agreed. But initially, what was communicated to the bankers and what was on offer? It was an entire block of 14%, right? So the initial intent,
14%. It was the initial intent was 10% of the block which I hold. That is 14%, 1.5% of the 10%, 1.4% of 14%. And as I told you, we still own almost 50% of the equity. So
you're clarifying that only 1.4% was on sale and that got taken up. Is that correct? You're saying that 14% initially itself wasn't on sale. We understood otherwise. That's why we're trying to clarify this.
Oh, yeah, that's correct.
Okay. So now you're saying the promoters will not sell any further stake. If you could just tell us the timeline. Is this for 2025? For how long will this hold?
This will be holding up. We can't just give you some timeline, but still, we are not selling anything right now. And that could be, you can say that in 2025, we are not going to sell anything.
2025. Okay, so Nishant, these clarifications are really important. So you're saying the promoter group will not sell any further stake this year, 2025?
Calendar or fiscal?
No, there are no immediate plans to sell promoter stakes. I'm giving a timeline if you are particularly asking. We are not going to
No, so, but are you saying fiscal year FY25 or calendar year 2025?
You can count it both ways. Like, we are not going to sell anytime soon.
The two are very different, but Nishant, the two are very different. If you're saying that you're not selling any more in fiscal, that means come April, there could be sale. I think, okay, let's also get to the broader point here.
We are not, there are no requirements to sell in calendar year 25 also.
You have no requirements to sell in calendar year 25?
We are not. That's correct.
We get that. So now,
and entering into new vertical like corporate travel and luxury tourism, there are a lot of innovations happening, leveraging AI, data analytics, including exploring blockchains to enhance consumer experiences. We are just going into promoting like eco-friendly tourism and carbon offset programs as well. A couple of things which the companies will be doing in calendar year 2025. Particularly to answer your question.
Okay, so there's a lot of innovation getting into corporate travel, etc. So you have resigned as a CEO, but you're going to stay on as a board member and the chairman of the board, right?
I'm the chairman of the company, that's correct. And I will be taking care of the international expansion of the company throughout. And Vikrant will be taking care of the Indian operations, the part which is going to handle up on a day-to-day activity. Okay, and all's good in the hood, right, between the three brothers? That's correct. Everything is fine between the three brothers. No, right. No, because from a shareholder perspective, they want to know what's going on with the promoter entity. A couple of other questions. You have sold some stake, in the recent past in 2024 itself. What are you going to do with all that money? We are going to diversify into certain, there's a personal choice, like we are exploring certain options, and which will be, of course, in line to travel verticals only. Like we only know travel. Since at the age of 38 years, I'm just 38 years, and my 20 years have been into travel. So we don't know anything besides travel. So everything will complement EaseMyTrip. That's all I can say right now. What happened to that bid for SpiceJet? Are you still interested in the M&A action in that sector? No, we are not.
Okay, so leave us with some ideas, some projections, a broad picture. I'm just going back and looking at some of the numbers because the market is also wondering what the promoter intent is and whether a lot of the diversification that has been spoken of or started this year, whether that's going to eat into the current cash levels, the current growth trajectory. So leave us with key numbers. Your CAGR revenue outlook, say for the next 1 to 2 years, the cash levels in the company, and the margin that you'd like to maintain since you're saying promoters are absolutely committed to the business of the listed entity.
That's correct. That's correct. Till now, we were focusing only onto the air travel part. Now, as I told you, we are focusing on different areas of travel. This could be non-air also. So in that, the margin numbers are too much. Like compared to the just flight tickets, the margins into hotel segment and the holiday segment are much more compared to the flight tickets.
How much is the cash, Nishant? Finally, what's the cash level in the company right now?
I think so. It's almost about 400 crores.
Okay. All right. Nishant, we appreciate you joining in and giving us some clarifications. We're going to be holding you at all these details, but thanks a lot for coming by. You've tried to clear the air on various aspects, and we'll hold you
That's
that
correct.
you
And
and the remaining promoters are on the same page and not looking at selling any more shares. Got it. We'll take that.
While also strategically acquiring, we are complementing businesses which we are doing on a personal capacity. This will also add up to a dual approach for each matter.
Got it. Nishant, thanks a lot for joining in. We have taken note of your journey, which has been great. But off late, the shareholders have been perplexed with regard to what they've seen. But you've clarified, so we'll take that on board. Well, thanks a lot for joining in. That's the stock price of Easy Trip. A lot of corporate actions. The stock has come out drastically from the recent top, but we have to take the promoter's clarification on board as of now. Prakash, what's your view on Easy Trip? A business that was bootstrapped and it started off very, very well, and they were growing the business till what happened in the last 12 months or so. Corporate actions, promoter selling stake, a lot of uncertainty.
Absolutely. I mean, that's exactly why it's not taken flight. And I hope, all these innovations that he's talking about come around in terms of creating shareholder value, which has been languishing for a while. It's a very competitive business. You can't keep on burning cash and expect to get market share when you have much more established business, have a head start. So things are difficult. It's not easy at all. But yeah, I mean, you'll have to wait for things to turn around before taking any kind of interest in terms of a buying call. But as of now, it's just wait and watch.
Prakash, do stay on. Need to slip into a very short break. We'll come back. We'll also chat with Mitesh Thakkar and Sudarshan Sukhani and get in a few technical trading ideas for the morning. Welcome back. Asia is a mixed picture this morning. Japanese markets, which were shut last week on account of New Year holiday, even on Thursday and Friday, have reopened and they've opened on the back foot. So down over 1% on the Nikkei right now, 1.2% gone. But some of the other markets like Kospi and Taiwan are up in the green, perhaps taking cues from the Wall Street bounce on Friday. The GIFT Nifty will also come up for you on the screen. It's suggesting a positive opening of close to about 50 points. Things have been a bit choppy. Thursday was a strong session. On Friday, we gave up close to about 200 points in the Nifty. And Monday morning, things look like they could start off on the positive note. But let's get in Mitesh Thakkar and Sudarshan Sukhani now to talk about a few technical trades. Gentlemen, good morning. Hope you had a restful weekend. Mitesh, let me start with you. What's your approach to trade?
Good morning. So, last week on Friday, we, kind of started declining after hitting the 24,200 mark, which was done on Thursday. So Friday was a negative day. Broadly, I think the structure is slightly on the positive side, but two things. One, we need to hold above these levels of 23,950, 930 zones. Two, I think once we cross 24,200, there could be a dose of momentum. So for the timing, I'm treating this 250 point as the immediate range. Would try to buy near the lower end of the range, which is closer to about 24,000. Take a 50-60 point stop and try to take profits around 24,200. And on a breakout above that, would go aggressively long.
Okay, all right, got it. Mitesh, Sudarshan, good morning to you as well. And by the way, Happy New Year to both you gentlemen. Let's get your call for the index first, Sudarshan. Any trades?
Yeah, good morning and a Happy New Year to you. On Thursday, I had suggested let's go long for the simple reason that the charts were a little conducive for a long trade. Now, no one knows it will go 400 points up, but we have to be on the side of the charts. Today, again, and Friday was a very normal correction. It was a dip, minor dip after that monstrous rally. Nothing to worry about. So the short-term uptrend that started continues and persists again today. After that dip, we are getting an opportunity to go long and buy the Nifty. Now, markets will remain choppy in the sense that they will not oblige us like they did on Thursday, going relentlessly up minute after minute. But the trend continues to be in the short term on the upside. Be long, keep a stop under 23,800 and just wait for a choppy ride, but eventually higher.
Okay, got it. Good morning, gentlemen. Thanks a lot for joining in. Sudarshan, you go first. Tell us about individual stocks as well.
Well, I have long ideas, and there are a lot of stocks that are giving signs of basing patterns, imminent up moves. Let's see what happens. ONGC is a buy with a stop under 250. SBI card is another dip, base, imminent breakout opportunity, stop under 710. After a long time, Tata Motors is suggesting that maybe the decline is over in it. So Tata Motors is a buy with a stop under 760. And finally, a stock that doesn't come much, Hoodco. That's a buy with a stop under 240. So I would suggest be very protective if you are taking shorts, otherwise be on the long side.
Mitesh, your stock calls?
Yeah. I have more of buy calls today, and FMCG is something which is catching my eye apart from auto. These two sectors are showing very good relative strength. So today I have more of FMCG stocks. Dabur is a buy with a stop at 518 for targets of 540. Marico is a buy. Keep a stop below 648. Look for targets of 685. A buy on DMart with a stop at 39.80 for targets of 41.30. And ICICI Bank is the solitary sell call. If it breaks 12.60, take a short position with a stop at 12.76 for targets of around 12.25, 12.30.
Gentlemen, we'll slip into a very short break. We'll come back with the pre-opening rates. We'll also be joined by Abneesh Roy of Nuvama Institutional Equities to talk about the ITC Hotels demer, Titan's numbers which just came out, strong jewelry growth of 26%, and also the updates from Dabur and Marico.
Welcome back. This is Open Exchange, and we're coming to you live from the CNBC-TV18 Motilal Oswal studios. Well, we've got the technical picture out of the way. Let's look at some FNOQs for the morning as well. We've got Chandan Taparia joining in from Motilal Oswal. Chandan, hi, and good to be speaking with you in the first conversation that I'm having with you in 2025. So happy New Year. What are the trades now?
Good morning, Surbhi. Thanks for having me. Happy New Year. Looking at the index, we witnessed a decent recovery on Thursday, but it failed to cheer the momentum on Friday. Index failed to surpass its 50-day exponential moving average, but trend is now turning to slightly buy on decline stance after the recent recovery in last week. So I believe that any declines towards 23,850 could be the buy on decline stance with support of 23,700, with the view that index can again head towards 24,250 to 24,400 levels. Talking about Bank Nifty index, it failed to cheer the momentum on Friday. Momentum fizzled out and now again got stuck in a range. So 50,500 to 51,500 is going to be broader range. And if I compare Nifty versus Bank Nifty, I believe Nifty may provide more stability than the Bank Nifty and needs to hold the 23,700 zone with buy on decline stance in the index. Now looking at the stock specific idea, first there is buy on Bata India. The stock has seen a consolidation breakout of last 100 trading session, with a strong comeback in the entire week. It is holding well above its volume weighted average of the week and added built-up of long led by short covering. So one can buy Bata India with support of 1415 and Bata can head towards 1520 level. Second trading idea, there is buy on Tata Motors. It surpasses falling supply trend line and bottoming out after the weakness of last 18 weeks. We have seen bullish divergence and bullish crossover on the daily and the weekly chart, which clearly indicate short covering spike, and open interest activity also indicate some price action on the upside. So one can buy with support of 775 for an upside target of 830. Last trading idea, there is buy on Lodha. Here we have seen a decent corrective move and bottom out approach again. Major trend of the counter is positive. And after the corrective move of last 13 days, it is now respecting well to its 50-day exponential moving average and turning higher. So better risk reward ratio on the lower time frame. One can buy with support of 1375, and this stock can head towards 1475 marks.
Thank you, Chandan, for joining in. By the way, strong update coming in from Jubilant FoodWorks, where in Q3 the top line has gone up by 56%, and the like-to-like for Domino's, the same-store sales growth stands at 12.5%, and we haven't seen a double-digit like-for-like growth for Domino's stores, at least in the last couple of quarters. Q2 was 2.8. Q1 was just a tepid 3% growth. So strong update coming through there.
You know, Rima, on 2nd of January when I joined, one of the stocks that had given as a stock to watch was Jubilant Food, because the stock was making newer highs. It was seeing a bit of a short covering bounce, and delivery-based buying as well was there. So it seems the streets sniffed the pizza, and the pizza is quite good, as per that update.
Yeah, indeed, 12.5%, very, very strong. But let's invite Abneesh now. Abneesh Roy, the Executive Director at Nuvama Institutional Equities, to talk more about the consumer sector. Abneesh, before we get to ITC, on Titan, we just got the Q3 update. The overall sales growth 20%, 24%, jewelry 26%. But I remember the concern in Q2 was on margins, and they downgraded their margin guidance, citing competition. How did these numbers, stack up versus your expectations for Titan?
Yeah, I think it's a decent set of numbers by Titan. Clearly, marriage season and the festival season and the strong gold pricing is helping Titan and other jewelers. You're absolutely right. The concern on margins continues to remain. But my sense is now base becomes a bit more favorable. In first half, the base was adverse. Also, with a 25% kind of a growth, they can get some level of operating leverage also kicking in. Here, what we need to see is how the gold versus the studded share is. Because studded generally, obviously, is higher margin. That and competitive intensity, that has been the key concern for Titan. So overall, I think sales numbers are decent, but I think largely as per expectation. And my sense is other jewelers also should see good numbers because of these reasons, gold pricing and strong marriage and festival demand.
Okay, all right. That's Titan. And of course, gold jewelers, which have had a pretty good showing. Now on to the other news, the big one, Abneesh, and that's ITC, right? We're looking at the demerger of the hotel business finally getting in motion. What is the kind of valuation you're ascribing to it? And, X of the hotels business, what do you see ahead for ITC, the rest of the businesses themselves? I mean, I'm just trying to understand whether as a shareholder, you'll be more optimistic on the X of the hotels business or hotels or both.
Yeah, so hotels business was a very small part of ITC's overall SOTP. It is not that we were not doing SOTP. But yes, I think it's good win-win for the shareholders also and for the company also. So we expect that the hotel, once it gets listed, say in February first half, we expect around 35,000 crore kind of market cap for ITC hotel business. And today, of course, ITC stock should account for that. So you'll see some technical correction there. We expect around 15 rupee kind of a correction in ITC main company. But ITC currently will not be in our top picks. We continue to like from longer term, but February 1st union budget is a key monitorable. Our personal belief is probability of a sharp tax hike in cigarettes on February 1st is very low, given the illegal industry continues to remain concerned. And even in Q3, we expect 3.5% volume growth for cigarette. So I think the rational tax industry for cigarette is the right way for the government and for the customer. But overall, Q3 results for ITC will be a bit muted. We expect almost flattish EBITDA because FMCG business is likely to see profit decline because of the palm oil sharp inflation, because of the maida sharp inflation. And even paper business will see weak numbers. So overall, ITC good from long term. But currently, our topics will be essentially United Spirits, United Breweries, Marico, and Pidilite.
Okay, all right. Hi, Abneesh. Thanks a lot for joining in. Just a couple of details. The ITC stock price today corrects by around, adjusts by around 15 to 20 rupees. Is that correct?
Yes, that is our expectation.
And what kind of value do you ascribe to the hotel business? If you could give us that share price number, and also what multiple are you giving it? Because you have Indian hotels that gets the premium, and then the other players, they get anything between 15 to 25 times. So what value are you giving to ITC hotels?
Yes, so in our view, ITC hotels, once it starts trading around 35,000 crore kind of market cap, and we think the industry and the street could value at around 25 to 30 times EV EBITDA, given it's much larger than most other peers. Of course, Indian hotel is bigger, and we see that around 150 rupee to 175 rupee could be the price of ITC hotels once it gets listed.
Okay, we just had Jubilant Food as well that came out with a set of numbers, which looks pretty okay. The stock is at a fresh 52-week high. What's your view on the counter?
So clearly what we are seeing is market share gains for Jubilant Foods are happening. If you see even past few quarters, the numbers are improving, and the gap with Pizza Hut, when you see numbers of Devyani, etc., Sapphire, etc., clearly gap is for Domino's is increasing. Second, the stock has also done well apart from the recovery in the same-store sales growth and delivery format. Of course, at the promoter level, what's happening at the Coca-Cola franchisee, that is also interesting development. And now my sense is clearly we will see Coca-Cola getting sold inside Domino's stores also. So clearly we are seeing Jubilant Foods, lot of optimism, lot of positivity. And this kind of number is a good number. You have to note that it is now almost 8 quarters of slowdown which the QSR industry has seen. So that has brought the base effect clearly. But we are seeing this quarter that Avenue Supermart also positively surprised, and Domino's also clearly positively surprising. So clearly market share gains are possible for these very well-run companies. So Q2, if you see Avenue Supermart, investors were not happy, but I think they know how to come back, and we have seen 10 stores getting added in Avenue Supermart, and they have done well, 17.5% sales growth. So I think Jubilant Foods, we remain positive from longer term. Of course, valuation comfort is low there. The stock has done well, but it's a good number for Jubilant Foods, same store sales.
But do you think QSR as a space is now turning around after 8 quarters of subdued growth? We saw Jubilant's numbers, but what about for the rest of the pack, like a Sapphire Foods, Restaurant Brand, etc.?
Our sense is clearly 8 quarters of slowdown means that the base has become favorable. So I think the worst is behind. But this kind of a strong numbers for Jubilant Foods, I don't think the other players are currently seeing. This is more of a delivery format doing well, in which clearly Domino's is the number one player. And previous quarter also, if you see within Domino's also, the in-store dining was not as strong as the delivery format. So this is more of market share gain. They have done well in terms of pricing. They have made free delivery options being there. So I would say that this is more of a Domino's specific, but yes, 8 quarters of slowdown does mean that the base has become favorable, and you will see gradual recovery, but not this kind of a number for other QSR in December quarter.
And what's your target price for Jubilant Food?
The numbers have come, and we'll see how the overall EBITDA, etc. pan out. But from a longer term, we are positive. But currently, our top picks in that space will be more like Trent, V-Mart, etc.
What about Dabur and Marico? What were your key takeaways from the business update?
So we continue to prefer Marico. If you see in FMCG, clearly the mid and top end of urban is still doing quite well. The problem is the lower end. So Dabur, if you see mass consumption, so clearly there the impact is there. Impact of Campa Cola is also there. You will see the same thing pan out for Tata Consumers weak numbers in Narishco in Q3. Although they'll see good volume growth in Narishco, overall they will see sales decline in Narishco this quarter also. So we are seeing that Campa Cola impact and the lower end of the urban consumption is an issue for Dabur. Marico, if you see good set of numbers. So we would be quite positive on Marico from a near-term, medium-term perspective. Stock has done well, but for Marico, 6% volume growth and 15% sales growth is a good number. Now, some investors may see that gross margin pressure, EBITDA margin pressure, but that is how Marico operates. So when sharp inflation happens, they take pricing, but they also go for market share expansion. So we are positive on Marico. Our sense is for Nestle, etc., I think still valuation correction has happened, but triggers are missing. For urban-focused companies, I think clearly triggers are still missing. But Marico has done well because they cater more to the mid and top end of the urban consumption, not to the lower end of the consumption in their foods and personal care.
Okay, so perhaps Marico, the stock to watch in this FMCG earnings season. Got that, Abneesh. Thanks very much for joining in and giving us a color on some of the updates that have come through, and of course ITC as well. Really appreciate you joining us on the show today. With that, let's shift attention back to the market. So now that the pre-open rates have settled, let's quickly take stock. About 40 points up on the Nifty. That's what the pre-open is indicating at this point in time. Bank Nifty is absolutely flat, not doing anything at all. We'll watch out for the reactions in some of the bigger stocks where the updates have come in. Let's, for instance, pull up a Bajaj Finance. Bajaj Finance is up about 1.25%. Been looking at some of the brokerage commentary, which is fairly optimistic. The numbers are pretty good, 29% AUM growth in this quarter as well. And then there is HDFC Bank, which was the other one. Now, with HDFC Bank, the problem is the deposits are growing, but they're growing at what cost? It's term deposits which are growing, not so much CASA. CASA ratio has been coming down for HDFC Bank, so watch this one. That's under pressure. Let's quickly get to our technical experts then for some final advice before trade begins. Sudarshan, 910, what's the call?
Well, consider buying Tata Motors. Tata Motors, buy with a stop under 760.
Okay. And Mitesh, what would you go with?
I'll go with the buy on Marico for targets of 685 to begin with.
Marico. Okay. So that's sort of the technical advice and the fundamental advice coming together in sync, because we just had Abneesh there talk about his optimism on Marico as well. Mitesh, very quickly before we let you go, just a word on the other two biggies on Bajaj Finance and HDFC Bank, if you have a trade at all.
Yeah, like the Bajaj twins, both Finance and Finso, and I think they have started to move, which should see them at least test the recent swing highs. So for Bajaj Finance, the targets would be in excess of 77.50. But HDFC Bank, the chart structure is slightly weak. And my belief is that I think, HDFC Bank could possibly do a range of 1700 to about 1820 in the next few weeks. So somewhere in the middle, right now I don't want to take a call, but around 1700 maybe you would want to trade for a short coming bounce back.
Got that. Thank you very much for that. Abhishek is now joining in while he's watching SBI Cards and Bajaj Finance, of course. Very strong growth numbers.
Well, to begin with, brokerages have upgraded SBI Cards. So we have Nomura, who has upgraded it to buy, raise the target price to 825 from 625 that they had earlier. They say that they are observing a few major concerns in the near term, especially with respect to asset quality. However, they expect credit cost to be at 9.1% in FY25 and then fall to about 7.5 and 7% in the subsequent financial years. So companies likely to be the biggest beneficiary of any potential rate cut that might be seen in FY26. We also have Nuvama on SBI Card. They have upgraded it to buy, raise the target price to about 850 per share from 620 that they had earlier. They say that credit costs shall improve from Q4 FY25 onwards. A potential rate cut by RBI over coming quarters will actually be very positive for SBI Card. Now, Bajaj Finance, the brokerages are upbeat. They say that Q3 business update in terms of AUM growth is much better than investors feared. As they expected a sharper YOY deceleration, but it has grown by 28%. So customer addition was the highest ever seen in a quarter, and focus is now shifting to credit costs, which may peak out in Q3 FY25 and then start improving from Q4 FY25 onwards. Now, Citi has their 90 days positive catalyst watch open on Bajaj Finance, and they expect management transition update along with Q3 earnings momentum this time around. So watch out for that on the result date. Brokerages remain upbeat, buy overweight and buy target from BofA, JP Morgan and Citi. Target price ranging from 7,300 to 8,800 per share. Back to you.
Okay, all right. Thanks very much, Abhishek, for that. So watching out for those two names from the financial side. Let's get back to JSW Energy. Vivek is back with us. Vivek, just remind us on this tariff issue that has not been approved. What can be expected?
That's right. So it's a clear negative as far as JSW Energy is concerned, given the fact that the company would have hoped to go ahead, sign the PPA, and then go ahead and start delivering on this particular project. Quick context over here, Jan 2023, the company announced with the exchanges that they had won one particular 500 megawatt project. This is a battery energy storage project. This is from SECI, the Solar Energy Corporation of India. What was pending was this agreement to be signed in terms of both the supply sale as well as the power purchase agreement. Both of them were delayed, and also the tariff that was discovered in that particular auction or in that particular bidding, CERC has not approved that particular tariff. CERC states that the tariff discovered there is much higher compared to what has been discovered recently in latest auctions. And along with that, they also say this particular development, there has been quite a lot of delay from the SECI in going ahead and signing both the supply side as well as the power purchase agreement. Negative as far as JSW Energy is concerned, but the company says that they will go ahead and appeal this particular verdict by CERC.
Okay, all right. Thanks a lot for that, Vivek. Well, let's quickly wind this down. Manglam joins us to help us out with a few updates that came in. Manglam.
Well, we start with Titan that just recently came in strong revenue growth. It's led by festive and wedding season and gold price rise. If you look at the jewelry business, the standalone revenue grew at 24%. Jewelry business showed a revenue growth of 26%, in which it was led largely by gold coins and gold itself because of the gold price rise. 24% growth out there is what we've seen, whereas studded sales showed a good growth of 21% as well. But because of the gold price being higher and gold sales being higher, studded ratio may come down. Other businesses, barring watches and wearables, which grew 15%, haven't shown as big growth as expected. Emerging businesses in particular have grown just by 5% due to flat sales of Taneira. Key to track will be performance of all the other players that they report, because over the last few quarters they've been outperforming Titan. Margins would be lower due to higher salience of gold price and lower studded ratio. And growth path for CaratLane and Taneira are something that I'll particularly be watching out for. For Titan, see mild green at the open. Perhaps thereafter we'll look for more details coming by. For Marico, good performance coming in on the revenue front, largely led by price hikes in copra and vegetable oil. Out there, the operating profits is something that the company is a little watchful about, but good growth overall in the revenues itself with sequential volume pickup. See green there. And Nykaa as well, over 20% overall revenue growth, led by beauty business, gross merchandise value growing over 30%, fashion growing 20% as well, slightly subdued on the fashion side, but beauty will more than make up for that.
Okay, and it is looking rather beautiful right now in the pre-open. Nykaa is up about 4%. Manglam, thank you very much for that. So a lot of these updates are going to be, of course, in sharp focus from the BFSI space and from the consumer companies that have reported over the weekend. Well, we're almost starting off with a 40-point pop. The problem, however, is the bank Nifty. Let's see if it is going to be in step with the Nifty or not. To begin with, there's a bit of a red on the bank Nifty, and if you look at some of the names, then on the downside, there is a Kotak Mahindra Bank, there's HDFC Bank that's starting quite soft. There's Cipla, Tata Consumer on the way down. There's JSW Steel also, Tata Steel slightly lower, and Coal India slightly lower. So steel, some banks on the weaker footing as we speak. The Nifty is also losing ground. Now the 40-point pop is just about a 20-point pop. Gainers include Bajaj Finance and Finserv because of the reasons that Abhishek mentioned, 28-29% AUM growth, lots of positive brokerage commentary rubbing off quite well on the stock. Titan's numbers are being well received by the market, 1.5% higher. There is Shriram Finance, SBI Live. These are some of the other names that are up and about. And tech is starting with hope and promise because it is the beginning of the earnings season this week with TCS. So you've got Infosys, Tech Mahindra, Wipro, HCL Tech. A little bit of a tinge of green on most of these stocks. So we have to watch for the banks because they're offsetting whatever little excitement that the tech stocks are showing. The bank Nifty is now down about 45 points at this point.
Well, that's right. Just take a look at a few more stocks, Surbi. Angel One, their trading update, in fact, is ahead of most estimates. The average number of orders declined by around 21% month-on-month. That compares with an expectation of a 30% decline. The client acquisition as well increased quarter-on-quarter. MTF book increased quarter-on-quarter, and market share is more or less stable. Explains why that stock is up close to around 5%. Jubilant Food, we had highlighted this last week itself. There was delivery-based buying being seen out there. There were some shots that were getting covered out as well. The stock has made a fresh high post the quarter 3 numbers. So big move is what we're seeing on that one. Easy Trip, we had Mr. Nishant Pitti who joined us, and he clarified that neither him nor the other promoters are looking at selling any stake. Explains why the stock has opened up higher, but we'll have to see how long it can stay at those levels. For the time being, big volumes up close to around 8%. DCX Systems, another stock that was on the radar last week as well. We're seeing some bit of delivery-based buying. They've gone ahead and won a large order. The street likes that. So explains why that stock is up and about in today's trading session. What's on the downside? We have Dabur that's down close to around 3%. So that comes up for you on the screen. United Spirits is seeing some kind of profit taking. And Union Bank is down close to around 5% or thereabouts. But otherwise, green on the screen. The Nifty holding with mild gains. HDFC Bank, that's down close to around 0.5%. I think that's going to be the swing factor for the day.
Okay.
SBI Cards, let's just quickly chat about SBI Cards because there was an upgrade from Nomura. Target price now set at 825. Nuvama has upgraded it to a buy. Their target price is 850 and it's a strong start for SBI Cards as it gains close to about 4%. Nykaa is another one opening up with strength. As Manglam was just telling us, the BPC, the beauty personal care category, has seen a growth of 30% plus for the company, and that's a positive opening. Macro tech developers also came out with their Q3 update. The company has reported the highest ever pre-sales. Pre-sales in Q3 went up by 32% on a year-on-year basis. The company has brought down its debt. It's a good opening for macro tech developers. Another real estate stock is Brigade, where the company has just announced that they are planning to develop a residential project in Bengaluru with a gross development value of 2,700 crore rupees. JSW Energy, another one we were tracking, has opened with a cut of nearly 2.5%. And pull up HUL because there were some reports which suggested that the company is looking to snap up the skincare startup Minimalist for about 3,000 crore rupees. HUL, it's a report as of now. CNBC-TV18 has not confirmed it. It's a flat opening for HUL and ITC. I don't think that's got a trade right now. Just waiting for it to, the price discovery.
Yeah, the price discovery will happen for an hour.
For an hour, so no trade yet on. And Kotak Mahindra Bank, on the back of the CTO resignation, is also on the back foot.
Just one word on HDFC Bank. That one, in fact, it moved briefly into the green. Now it's still down, but it's down marginally. It's come off a little bit from the low point of the day. So that's the stock, I think, to track for today. Its low today is 1,736 rupees odd. The street was prepared for a softish showing. It is a little bit softish, but let's see whether or not we see a bit of a bounce from the day's low.
Banks are really playing spoil sport. No denying that, because Bank Nifty is down 120. But what's happened is that even for some of the larger franchises like HDFC Bank, even if they're mobilizing deposits, the question is at what cost? And in HDFC Bank's case in specific, it's more term deposits. You have to pay more interest on those term deposits. They don't come as cheap and convenient as CASA. And CASA ratio has declined for the bank even quarter on quarter. So those are some of the concerns perhaps that are weighing on the stock this morning. But more on the markets with our next guest. Our market master of the morning is Devina Mehra, founder, chairperson and managing director at First Global. Devina, great to see you in the new year. First of all, wishes and greetings for a very happy, healthy and of course wealthy and prosperous new year as well. So let's start right there. The interesting factor is that as we were collecting a lot of the opinion as 2024 was rounding up, for the first time in many years, people were really tempering expectations. Even the poll that we did a street viewer street poll that said that expect maybe just high single digit to low double digit returns in 2025. Do you share that sense of cautious optimism, if I could call it that?
And wish you and your viewers also a very happy new year. May it be a blessed year for everyone. So coming to the one-year expectations, I have never given a one-year picture either in January or at Diwali time. And I recently wrote an article precisely on this, that what you should do with one-year projections. First of all, you should see what people said a year ago, 2 years ago, 3 years ago, because Bloomberg actually did a study which went back 25 years and all the big names in the world, so all the Goldman Sachs and the Merrill Lynch's and HSBC or Deutsche Bank or Citicorp and all the people listen to very carefully that they have a hold on what's going to happen. And the projections were off on the average by 15% points. So if somebody said the market will be up 10%, it could be up 25 or it could be down 5. And everybody clusters together because it's easy when everyone is wrong together. So that should tell you what to do with one-year projections, because that's in a category called objective ignorance, as Daniel Kahneman calls it. That is not just a thing you don't know, but you cannot know. But coming to expectations, yes, I think expectations in general have run far ahead of where they should be. I have people coming to me and saying, yes, I'm fine with a conservative portfolio. I'm fine with 30% return a year.
So 30 is the new conservative, huh? That's the problem that we're dealing with. But Devina, hasn't a lot of that started, tempering? Because we have seen a time correction, maybe not a very savage price correction, but definitely a time correction. The market hasn't been galloping one way higher like it used to. I mean, we've been in this zone for now a little over 3 months.
Yeah, I mean, as you should be. If you go back again 18 years, if you look every year, there have been only 3 or 4 years where we haven't had a double-digit correction. So in 2023 also, we did not have it. So you can say after 2 years, you saw just in the double-digit category. So it was not something which is unexpected if you are really an observer of the markets and really look at data. So we had been expecting this. Of course, we bought hedges in the middle, but the market continued to run up. So we were cautious in March. We were cautious in June before the election results, but we did not go into cash. We bought hedges. So this year we've spent some money on hedges, but that's like, we didn't get used in a sense, but that's like buying health insurance and not getting hospitalized. I don't think it was a waste, but this was not something we were not expecting. As far as the situation now is concerned, I think if you have made money in very frothy areas, time to move to a steadier, more conservative portfolio, because I don't still see a big risk in the mainstream, larger stocks, which is not to say that the market can't go down another 5%, it may, but I'm saying I don't see a big risk of a crash, because that comes when you're way out on the return trend line and you are still not there, primarily because 2010 to 20 was a very bad decade for the market. You didn't even make anything more than fixed deposit returns for a whole decade. And that's why you had this bull run. I mean, from, I think, the COVID lows, the Nifty is up something like 220% and the 500 is up some 270%. So we've had a great run, but I don't think you are still in that territory where you will we're looking at a crash. The small cap, micro cap, that category is different, because again, people with a very who are very new to the market don't know that in every bull run, some of these stocks that run and then there is a correction or crash or whatever in the next uptrend, it's not the same stocks that go up in general. So, keep that in mind. So, as I said, if you made the profits, or even if you haven't, get out of the frothy areas and get into more conservative portfolio, steadier portfolio, and properly risk managed.
Devina, in the past, you've highlighted how banks, despite being a consensus overweight, hasn't really given oversized returns to investors. They have largely underperformed. Now going into 2025, what's the call on the banking and financial sector? And pharma seems to be a big overweight for you.
Yes, pharma has been an overweight since, I think, first or second quarter of 2023. And again, pharma had a poor run prior to that for many years, which created the room for this up move. And so we continue to be overweight pharma. Of course, in the next 10 days or so, we will be doing a quarterly rebalance. So, but we are still overweight pharma. We are overweight auto components and IT. These would be our overweights. Capital goods, industrial machinery, which we were overweight for 3 years, unlike most fund managers who discovered it in 2023. We were overweight from 21. Now we are underweight. So that is the picture as far as pharma is concerned. And what was your other question? Sorry,
Banks.
Said on?
Banks, I think, is what we. I think, Devina, if I remember correctly, you have been underweight banks, right?
Yes, we have been almost always underweight banks since we started the PMS almost 5 years now. As someone was saying, you repeat this in every interview of yours, that I am a nervous investor in banks and lenders. And the primary reason is that that's a thing that's an area which always gives negative surprises. And if you look at from 2020, in the past 5 years, it has underperformed every single year except 2022. And 2022 was the only year where we were market weight to slightly overweight on banks. Otherwise, we are almost always underweight. And if it wasn't the biggest weight in the index, probably I would love not to look at it. But even last year, if you see, the Nifty is up more than 10%. Of course, the broader indices are up even more, and Bank Nifty is up 5 and odd. And 2020, it was the only sector which was the only major sector in the negative. 21, again, it was half as much as the market. 23, again, underperformed. So every year, if you see, they generally underperform. And so that's the thing, that that your lender, your borrower does very well, you don't get anything extra. So you are in a highly leveraged business where the only thing is on your kind of luck part is not there on the positive side, it's there on the risk side. And if you look at the numbers also, I think now there is in the whole credit system, may or may not be exactly the banks, there is, I think, pressure building up on credit. A lot of indicators like that, like gold loans going up, which means people are forced to mortgage jewelry. And then this is something I heard Mr. K.V. Kamath saying, and that was a light bulb moment for me, that if you look at the two sides, that if you look at all the losses that are made, let us say in the F&O market, which is, I think, something of the order of 1.5 lakh crores, and that's likely mostly funded through these unsecured credit. And of course, there's issues on the deposit side also. So, and also remember, theoretically, also bank margins go up when interest rates go up. Which is when the loans get repriced immediately and the deposits, the interest rate goes up for the slowly. So now you're again not on the right side of the cycle there. So those are all the concerns. I mean, it may be a market perform, I think, at best, banks.
But Devina, so, kudos on the pharma call, because actually if there's something that's worked really well in the last year, is actually pharma and healthcare. They have been the best performing indices. But I'm coming back to your point. You're saying stay away or, clear a bit of the froth in your portfolio. It's time to get a little conservative. Now, how else do you do that? Banks, you sort of outline some of the concerns that you have. Healthcare, you're overweight on. But how else do you take that conservative stance? When FMCG, we've been discussing this whole problem of anemic growth, for instance. And wherever there is growth, one can argue valuations are maybe still elevated. I mean, whether you're looking at jewelry stocks, you're looking at a Trent, etc. So how else do you get conservative, and which is the frothy part of the market where narratives are still strong, but you still see some froth? I mean, whether it's EMS or renewables, EV, the narratives are going very strong. But are you concerned about the prices?
Yeah, I mean, we don't generally go to those kind of frothy areas. If you look at, for example, there were a lot of defense funds that came out in the first half of 2024, and they have underperformed. So I always say that one, easy thumb rule is to know where froth is to look at the areas where the new fund offerings are coming, because that's normally when that theme has matured and is close to the peak is going to likely fall from there. So be concerned about that. If you are in micro caps or stocks generally below, let us say 5,000 crore market cap, that's an area where risk management is very hard. So if those stocks fall, your stop losses don't work because they just keep falling. And also there is no hedge available, because the only liquid hedge is on the Nifty and on the Nifty put, and then that doesn't move with the small cap. So that's like some easily identifiable area. Any new area that's coming up, if you want to have an exposure, have some exposure, but that should be a small portion of your portfolio, because companies with no history are inherently risky. And also remember that even if a company is doing well in a particular, if they've created a space, if they've created a business where none existed, if it's very attractive, that will draw in more players, so more competition, pressure on margins, etc. So, all those things also are there. So be careful. FMCG, yes, I mean, we've been watching for the last few months, and we have increased exposure in the middle of the year. But that story has been stalling. I mean, I'd seen, of course, the consumption slowdown has not come in the last 2 quarters. If you look at financial year 23-24, and you look at the GDP number, the private consumption number was at a 21-year low or something. So, I mean, people started looking at it only when the market started correcting.
Yeah.
But the problem is that the inflation has been a little more persistent than I thought. I thought good monsoon now, food prices might go down, and therefore that will be a relief for the FMCG. But then, palm oil prices, everything has been quite strong. So, but I think, FMCG is probably somewhere in the bottom area now. It may not be the standout performer, but it's not looking too bad either.
Okay, so, perhaps something on your radar. And let's see, we'll take that up in our next conversation. But thank you so much for joining in. Once again, wish you a fantastic 2025 and look forward to more conversations. By the way, speaking about the slowdown, guys, I don't know, there were a lot of articles over the weekend talking about how the sales, end of season sales, the discounts are ranging between 70-80% because there's so much inventory that these brands are trying to clear. So I guess a lot of it, because the companies are not listed or the brands are not listed here in the market, doesn't get captured. But I suppose it's just another sort of facet of this urban consumption slowdown that we're talking about. Anybody heading to the mall over the weekend? 60, 70, 80% discounts apparently.
Okay, all right. Well, let's move on. Let's invite our next management on the show. We have Rainbow Children's Medicare. That's the next stock on our radar. To discuss the expansion plans, business outlook, we're joined by Dr. Ramesh, the chairman and managing director at Rainbow Children's Medicare. Hi, Dr. Ramesh. Good morning, and thanks a lot for joining in. Well, I've had the privilege of visiting your hospitals in South India, and boy, oh boy, you're taking care of the little ones, and best in terms of medical assistance is what I understand in parts of India as well. Well, tell us, Dr. Ramesh, how are things shaping up? you have big capacity addition plans. I think you're close to around 2,000 beds. Tell us about how do you see these capacity additions take place? And also a word on your expansion in North India, namely Delhi, Gurugram. I believe that out there you're looking at increasing your beds by a couple of 100 beds. Tell us more of that.
Yeah. Thank you, Nigel. Happy New Year to you. So our the bed expansion almost we're going by 50% in the next 3 years' time. By calendar year 27, and I think we'll be adding about 1,000 beds. Most of the beds, about 450 beds, are going to be in Gurugram, and the rest of the beds are going to be in the south, mostly in the form of regional spokes as well as the city hub and spoke model. So this is how we are looking at it. In terms of Gurugram, we are kind of almost close to obtaining permissions. We are kind of planning to do a groundbreaking towards end of February or first week of March. So from there, I think it will take about 2.5 years' time. Maybe by 27 mid-year, we'll be operating both the hospitals in Gurugram.
Okay, all right. So 400 beds is what the addition is likely to be in Gurugram itself, out of the total 1,000 that you're looking at by 2027. Is that correct?
Yeah. We have a possibility of 200 beds coming in the form of acquisition, which is we are in the initial phase of working on it. Probably kind of we will know in a few months' time.
Tell us, where is that inorganic growth, Dr. Ramesh? I remember pushing you even when you had joined us on Inside Out. I was trying to quiz you, where exactly are you looking at? So this 200 bed opportunity, first of all, the time horizon that you're looking at, and if you could give us a broad geographic idea. Is it in that part of the world, the northern India?
Yeah, as I was always kind of been passionate about the Northeast, so that's likely to happen soon. And also kind of the acquisition closer to Hyderabad as well.
So these are two separate acquisitions. Hi, sir. Great to have you on the show, Surabhi here. So you are looking at two separate target entities, one in the Northeast, one in Hyderabad. Could you give us a rough sense of how large these entities are, bed capacity, and what are you thinking right now in terms of funding these? How close you are, and whether the funding is going to be all entirely through internal cash?
I think the Northeast one is right now they have 100 beds. I think we are kind of working on expanding to 150 beds in the Northeast. In the South, which is one of the tier 2 cities closer to Hyderabad, we are working on about acquisition of 75 beds. So
and by when?
I think these things too should happen in the next 4 months' time, 4 to 5 months' time. This is what we are working on. So. CapEx wise, so we have a lot of internal accruals. That shouldn't be a problem. We would be kind of taking over majority of the stake in both the places. We still yet to decide how much majority we're going to take.
So your cash was about 580 crore as of September. Will that be enough for you to fund your acquisitions, the two proposed ones, and your capex plans?
Yeah, that will be more than enough for the moment.
More than enough. Okay. And as you expand your bed capacity by FY27, what would the margins of the company look like, according to you? Because you've been steadily expanding your margins. So what's the trajectory on margins as you see it?
So we've been expanding in the last 3 years' time, kind of year on year. We are adding about 15 to 18% of the beds. We continue to deliver about 25-26% of EBITDA margins. We never failed on that. So how I look at it is that what we call is disciplined expansion. So if I'm adding about 250 beds in a year, then that will probably take about EBITDA pressure of a percentage or so for about 2-3 quarters. Otherwise, we'll come back to normal. So we've been witnessing this the last 3 years, and I think we'll continue to grow the same way. The thumb pressure will be there for a few quarters. Otherwise, we'll come back in quickly. One of the reasons our southern business is getting more matured and matured. So as the southern business gets more matured, that EBITDAs are not going to be a big problem for us.
Okay, all right. Just a quick couple of questions then with regard to this EBITDA per bed. I think as of last year, it was 6.4 million. Now, I'm reading a couple of brokerage reports that believe that in the next 2 years, it'll go to around 8 million. Do you think that could be the aspiration?
Yeah, I was looking at it. I think it would probably closer to the 8 million and may not be exactly 8 million. Suppose if you are growing our ARPOPs by 6% year on year, I'm sure we could achieve that, provided occupancy support us with the 55% of occupancy at a group level. We should be able to achieve that, closer to at least 8 million.
Got it. I just want a quick word on the Madhukar Hospital in Delhi. I think profitability is a little bit lower out there. You could help us out with that number. But the belief is that the margins move to mid-teens over there. Could you help us out with clarity on that front?
Yeah, I think it's Madhukar is a kind of would be probably talking about 10% or more than 10% margins. So this is a model where I don't think we we will achieve the EBITDA margins of 20 or 25% because of the cost structures, because of the free beds, what we are supposed to do, and also the high rental payouts to the owners. So these are all the kind of stumbling blocks there. Perhaps this is how DDA properties, trust hospitals work. So we are doing well, but the margins are going to be the same. But considering that our capex per bed was quite low, we believe it's okay.
So from 10%, it moves up a little bit, say to 12 to 15% in the coming 18 months?
I think it should go up to 15%. Beyond that, it's going to be challenging.
All right, Dr. Ramesh, you built a great franchise, taken care of a lot of children as well across India. What's the, the succession plan? I believe that your son as well is already on the board, but he's due to join the business. Could you help us out with that succession plan? Because succession is something that the stock market looks at very, very closely.
Yeah, my son is Adarsh Kancharla. He's right now doing a fellowship in London within the transplant fellowship program in King's College Hospital. So he has got a kind of seat in London Business School and is waitlisted in Harvard. So very likely he's going to join one of these two schools in August, September of current year. So we always believe in that. We have been a kind of purely doctors and doctor entrepreneurs. The next generation is likely kind of, if they come back with a business background to build the organization, will do better. So I encouraged him to kind of go for an MBA. So he's a bright guy. I'm sure with a medical background and business background, I think that's going to be a future asset for a long-term building of Rainbow.
Okay.
Thank you. Thank you, sir, for joining in. We look forward to chatting with you when your Q3 numbers come out and as and when those acquisitions close. Thank you once again for joining in. Get into a break. On the other side, Anand Agarwal of V-Mart Retail will join in to talk about their Q3 business update.
Welcome back. Just eye on the market and the color is completely red. Blame it on the banks. But it's not just the banks. Today, even the mid-cap market is feeling the heat. It's not a very pleasant looking screen early on because there's a decline of 0.5% on the mid-cap index and the bank nifty is really sliding.
The ITC, the initial rates are coming out because we have close to around that 40-45 minutes is over. So the rate that it settled at is 456, which would be a 24 rupee, I think, adjustment in comparison to Friday's close. So that as well will come up for you on the screen.
And there's just one more stock, LTI Mindtree, because there is a double upgrade on LTI Mindtree by Jefferies. It's now a buy rating versus an underperform, and target price stands at 6,650. LTI Mindtree has been an underperformer. So whole of last year, the stock didn't do anything. It was absolutely flat. While the Nifty IT index gave a return of more than 20%. So after this kind of an underperformance, Jefferies believes there is value at current levels. So double upgrade for LTI Mindtree.
Okay, there we go. So some stocks that are in focus, but otherwise the texture of the market is weak, at least at this point in time. What, however, is not weak is the Q3 update that we got from V-Mart Retail. That's the next company on our radar. Now, V-Mart reported what looked like a pretty good operational update for the third quarter. The revenue is up by about 16%. Same-store sales growth has come in fairly healthy in double digits as well. To talk about this, we have Mr. Anand Agarwal, Chief Financial Officer of V-Mart Retail, now joining in. Thanks very much, Mr. Agarwal, for being with us. I'm just pulling out the numbers for the benefit of our viewers as well. 16% revenue growth and same-store sales growth at 10%. It's very good, but if I compare it to the 9-month same-store sales growth, then it's 10% versus 12% for the 9 months. Let's dive a little deeper into what you're seeing in urban, in sort of semi-urban, rural, and what the contours are behind the 16% revenue growth.
Hi, good morning. I must say, I think the going has pretty been good for the last 1.5 years. We've been constantly improving on our operations, and obviously the macro also is helping. There's definitely far better traction that we are able to see both in the rural as well as in the urban segments. When I say urban, it's not really, so much of the urban customer for us. It's still a tier 2, tier 3 kind of customer who comes even in a tier 1 town for us. So that way, I think what we are seeing is a recovery from the last 2-3 years. Post-COVID, this segment had definitely, gone down a bit. And that is where we also saw our numbers, plummeting down a bit. But now for the last 1.5 years, we're seeing a good recovery, both at the macro level as well as a result of what we have been doing as part of our revamp and restructuring.
Okay, so give us some projections. Now we're almost done. I mean, just last quarter left in the full financial year, right? You grew 20% in the second quarter. Now the top line growth is 16%. So FY25, looking at the fourth quarter, what is the overall revenue expectation that you have?
I think we should still be able to grow at mid-teens or high teens. That's the trajectory that we have set for ourselves. I think quarter 4 is a very small quarter. But having said that, quarter 4 will also see early Eid and probably a winter Holi. So that should bide well for all of us and us included. So I'm quite hopeful that quarter 4 should also pan out quite well. We are also opening a lot of new stores. We have seen a good traction in the new stores that we've opened so far this year. And also the numbers look promising in terms of the performance or the sell-throughs that we are able to see on the ground. So quarter 4 definitely looks promising. At an overall level, therefore, the total growth should be in mid-teens or high mid-teens. At the same store sales growth level, I think high single digit or maybe just touching double digit is something that I would still target for.
How were the discounts, Anand, in Q3? Was it more than normal given the kind of urban consumption fatigue that we're seeing? And what would be the outlook on margins now?
No, I would not say that we put in more discounts. We did not see a lot of fatigue in the segments in which we operate, which is like tier 2, tier 3 towns, not as much in tier 1. We did not resort to a lot of discounting. There was a bit of concern early on due to the late start of winters, but later on, I think pretty much everything is normalized. There's a bit of concern around winters in East India and other central parts of India, but otherwise things probably remain normal. As far as the margins are concerned, I think we should still be able to see the kind of growth that we've been seeing so far. The numbers are still to come for quarter 3. So I would not like to comment so much on the margins, but margins should remain in a healthy range.
And what about LimeRoad? You had earlier indicated that break-even should happen by Q4 FY25. Is that on track?
Slightly challenging. It's a very, very small business, but an important business for us. It's less than 5%. The online business is less than 5% of our overall revenues. We've been constantly improving our performance on LimeRoad and the other parts of the digital business. The losses there have come down by almost 35%. The revenues have also come down. So we are not targeting to buy revenue. We are targeting to make that business sustainable. As far as the break-even is concerned, I am not too sure we should be able to see break-even this year. I think we are still some distance away from that. But the good part is that we've significantly reduced our cash burn. We've significantly reduced our losses from that business. And we are building towards a much brighter and a better online business as a portfolio for V-Mart.
So what's the cash burn right now in LimeRoad? And do you think by the end of this calendar year, is there a possibility it can break even?
Possibly, yes. I will not say again on a full year basis. There may be quarters, there may be periods where we will break even, where we may also have a profitability. But the online business is such mired with such complexities that it's very difficult to run that very profitably at a low average selling price. And our average selling prices on LimeRoad, as far as our merchandising mix is concerned, is definitely much lower. So we are running it more like a omni enabler for the V-Mart group, and that's the objective. So it will still remain probably a cost center, not as much a profit center in the near future.
Okay, so that's LimeRoad and the digital business. Finally, to come back to the capacity addition and the store rollout plan, I think you're at 488 stores as of December. How many more are you looking to add in this fiscal year, FY25? And overall, I mean, what's the rollout plan for the calendar year as well?
I think on a full year basis, we should be opening roughly around 55, 58 stores. There may be a few store closures that may come in Q4. We've not closed any stores the last quarter, that being the festive quarter. So we typically avoid any store closures in Q3. Q4 may see some amount of store closures, which are very normal, nothing abnormal. So every year there should be 1% of store closures, 1 or 2% of mistakes that we will actually always end up doing. So that will happen in Q4. But on a full year basis, the net store addition should still look like around 50 to 55 stores.
Okay, all right. Anand, we'll leave it on that note. Thank you very much. Once again, wish you, the very best for 2025 to you and, of course, your team at V-Mart Retail. That's V-Mart, but we have to, take the eye back to the screen as well, because this is, once again, a big decline. The only caveat is that let's keep the context in mind. Today, we're not falling alone. That's the little reassurance, because if you look at a lot of the regional markets across Asia, many of them are also seeing red. For instance, you're seeing the Hong Kong markets lower. The Japanese market is falling actually quite a bit, 1.5% down in Japan. So it's sort of mixed shades. Even the Chinese markets, despite what the PBOC said over the weekend about moderately loose policy, despite that, there's weakness in regional markets. But yes, for us, I mean, the concern continues. The selling in banks, when the Bank Nifty is now down almost 1%.
Yeah, and that's even though HDFC Bank is as flat as can be.
It's still not falling,
HDFC Bank is as flat as can be. So the other stocks, in fact, are contributing, namely Kotak Mahindra Bank, that's under pressure, and a couple of other names as well are lower in today's trading session. Just a few stocks that I want to highlight. Jubilant Foodworks, that's the outlier today. It's in this year itself, we're just not even 5 sessions into the year. The stock is up already around 10%. So that's seeing a good amount of price action. There were a couple of dips that we saw in the last 40 minutes or so, but that's quickly got bought into. So that's one stock that's clearly done well, 12% in the last 1 week, as my director very helpfully pulls up. And Crompton Consumer Electricals. We had highlighted this in the morning as well. The stock has fallen more than 10%, I think, in a matter of 15 sessions. But currently, it's trying to pull back a little bit. It's up close to around 2.5% or thereabouts. It's been a rank underperformer, but that's moving with some volumes as well. So just highlighting that stock.
And QSRs, that's the other theme. So there is a rub-off impact of Jubilant Foodworks on Devyani International, 4% up, and Sapphire Foods, which is up 4.2%. As Abneesh was saying, that QSRs have gone through a period of 8 quarters of subdued growth. So now the base effect is favorable. And so far, at least, some of the numbers from the consumption side, whether it's Avenue Supermarts or even Jubilant, do indicate some positive momentum. So QSR is a pocket which is doing well. And in banks, PSUs, the Nifty PSU banking index is down more than 2%. Union Bank has a fall of 6%. Bank of Baroda, PNB down 4%. Indian Bank, Central Bank, these are under significant pressure.
What's also standing out for me is the fact that even Marico came out with a pretty decent update. Third quarter update was good. They're talking about possibly double-digit growth, and some of their portfolio brands have done really well. But now that is really helping the sentiment, about 4% down on that stock. Dabur is a different story. Dabur anyway has been guiding the market towards a weak quarter, and they've said the pain in this, the general trade channel, that is continuing. So Dabur is also down 4.5%.
Just one more stock, IMFA, Indian Metals, Ferro and Alloys. We've been telling you all here on CNBC-TV18 for the last 10 to 12 months that there is a shortage of chrome ore, globally. And because of that, ferrochrome prices remain more or less steady, irrespective of what's happening with other commodity prices. IMFA is holding with a gain of around 2.5%. Noted investor Dolly Khanna's name had got, turned up in that 1% plus shareholding. So that could be one of the reasons why the stock is holding up with a gain of around 2.5%. And as Nimish has told us in the past, there could possibly be some kind of corporate action that the street is waiting forward to. In the last few days, the stock is up. Last 1 year, in fact, I think it's up close to around 50% or thereabouts. So keep an eye out on that one. And as we told you earlier, ITC, 25 rupees is the adjustment that we have seen on that particular stock as well. That pre-open special trading is out of the way, and this is listed now X of the hotel business. Well, Rahul Sharma, the Director and Head Technical and Derivatives at JM Financial Services, joins us on the show. Hi, Rahul. Good morning. 2025, hopefully it's a good year. Wishing you, your team, your family a very, very happy new year. Well, you normally join us and you normally give us that one kind of a data point that you're stressing on. What's it this time around? The FIs are net short. So what is the data point, if you could tell us? And also, what are the levels you're looking at on the Nifty for this year?
Yeah, thanks, Nigel. So, the good thing is markets have somehow managed to create a higher low over the last few weeks, and the 23,263 low that we formed in December seems to be intact. Now, this will remain a crucial level as we head into the big, the weeks where we have a lot of events. We have earnings, we have the US, president taking charge, plus also the possible rate cut happening in the first week of February. So I think incrementally markets should get better from here. 23,700 is a crucial support for this week, as markets will try to find their feet after once we start getting into the earnings numbers. And on the upside, I think slowly, gradually, we should be. So two levels in mind: 23,700 for this week, and the panic low that we had formed in December remains a crucial, all-important level in case you were to create long positions at these levels. Now, the technical setup is indicating that we are on the way up. There could be a bit of volatility, which is something there. And secondly, the positioning of the FIIs continues to remain short. That should get challenged once we cross 24,200. So 24,200 once gets taken out, may happen this week, may happen next week. I think the next stop for the Nifty should be at 25,000, which could be a short covering move, which can take the markets higher. So all in all, look to be a buyer on dips, look to buy around the support levels. And we feel that, over the next few weeks, market should do well from here.
Rahul, L&T, what is the chart telling you?
Yeah, so Larsen and Toubro has been sideways for the last few months, in fact, almost a year now. And this sideways structure is more of a technical, box that it has created on the monthly charts. Now, you could be an investor in this stock. We feel that the stock has got long legs. So, in fact, this is also one of our stocks for the year 2025, which can deliver a return of north of 20-25% on the upside. So one can look to buy L&T at these levels. I think the risk reward is very much favorable. This also is part of the capex theme that is expected to do well over the next few months. And technically speaking, I think this stock has got legs up to 4,500 on the upside. So 25% upside broadly. L&T remains our top pick from the capital goods space, which can outperform the market going ahead from here.
By the way, just taking a minute away from this interaction, just to point out that there's a lot of weakness in PSU banks today. Union Bank is down 6.5%, Bank of Baroda is down 4.5%, PNB, Central Bank of India, IOB. So the entire PSU banking pack, look at that, 3%. That's a crunching blow on the PSU banking space. The Bank Nifty relatively is better. Bank Nifty is down about 0.7%. I just want to put out, I think we'll get Abhishek as well to recap some of the updates, because BOB reported numbers over the weekend, the Q3 update. Union Bank's update I was looking at, sequentially deposits are down. Even year on year, the deposit mobilization is just 3-4%. So very, very anemic compared to some of the other private sector names. We'll put the spotlight on them in just a bit. But Rahul, coming back to you, and banks is really what I want to talk about. I mean, a slightly more medium-term perspective. Because this banking move has been a non-starter. You get a couple of good days, a trading bounce here and there on some names, but that big bank move, that's completely eluded the market in all of 2024. What do you see ahead?
Yeah, so at this point in time, clearly Bank Nifty is at a make or a break level. 50,500 to 50,000 are the twin supports for the banking index. It also happens to be the 200-day EMA support for the banking index. Now, clearly, the follow-up buying has not happened in the private banks. We saw them do well in bits and pieces, but eventually, they have to give these big breakouts, which have not happened as of now. So I think the best strategy at this point in time is to switch to NBFCs. NBFCs have done relatively well. In fact, the 21st November lows are still intact in something like a Bajaj Finance. And I think over the next 12-month period, this is one stock where you could keep your eyes on.
this stock is something which can come out of the last 3 years of consolidation that it has been. In fact, the stock has been broadly sideways over the last 3 years, and the breakout could very well take us, north of 25% in the same. So, there's a triangle pattern, as you can see on the graphs on the long-term charts, and this has shown resilience over the last few trading sessions. The kind of volume-based buying that has happened is clearly indicating that strong hands have entered into it. And I think if I were to bet money on one NBFC stock which can do very well, I think it could be Bajaj Finance. So rather switch to NBFCs as compared to what is happening in banks. Maybe wait for a better day and a breakout confirmation. Once that happens, that would be a better play at that point in time. But at this point in time, I think it is Bajaj Finance. It looks pretty solid.
Well, valid point you're making out there, and it's out of the blocks in a flash. It's the top nifty gainer for this calendar year so far. What are the ultimate targets you're looking at on Bajaj Finance?
Well, technically the projections are coming around 9,000, but I think 8,600, 8,700 is where one could look to, look at a target as, which is approximately around 20-25% from these levels.
All right, and the one that has defied gravity in the last few years has been Gravita. The stock pulled back a little bit after they raised some money, but you believe it's good for more. I think that's one of the top picks you have. What are the targets out there?
Yeah, so Gravita is something which is more of a continuation play. The stock did fairly well in the first half of 2024. Post that, it entered into a consolidation correction, time correction, if I may call it. I think, the stock has got a 40% upside from these levels and can be bought at current prices. It has got a pole and flag pattern on the weekly and the monthly charts, which it should, provide continuation in the current uptrend. So I think this can recycle into a new trend, and one can look to be a buyer in this, especially if you have a 6 to 12 month kind of a time frame. This stock can be the best performer of the all the stocks that we've discussed today.
And SBI Life, Rahul?
Yeah, so this is one of the bargain plays. So from the insurance pack, this is one stock which is available at a long-term support line. So, as you can see, 2020 onwards, there has been a rising trend line. The stock has taken support over there twice. I think, at these levels, the risk reward is very favorable, for a fresh upside. And, one can look to buy in this space for a potential upside of around 30%. So, insurance play plus the budget also coming up, I think there could be triggers. But at the same time, technically speaking, the risk reward is very, very favorable. And one can look to buy at these levels for an investment perspective.
Okay, all right, Rahul. Thanks a lot for joining in. I think the call that you are making is buy on dips in the near term till the lower levels get violated. And as we had that chat with Rahul, the stock, or the Nifty, the Nifty has recovered close to 80 points from the low point of the day. The few of those IT-related names, well, they are pulling back. They have moved to the high point of the day. So good move from tech as we speak. HDFC Bank is more or less flattish. So that's good news as well, because that's holding one end up. That's a bit of a fight back that we're seeing from the low point of the day. Slip into a short break. On the other side, Manisha Gupta is waiting for us. She'll tell us what's transpiring in the commodity space.
Mid-caps are tumbling, so mid-cap index is down 400 points, 0.7% lower now in the mid-cap index. The advanced decline ratio, which has been positive for the last 4 days, has turned adverse. We've got nearly 3 stocks declining for one in the red. At the day's low now for the broader markets. But let's talk commodities. Manisha is here with us in the studio. Manisha.
Well, thank you for that. I'm starting with metals here, which have started 2025 on a very mixed note right now. Well, there are two things to work on. One is the dollar index, which is trading at around 109. It's a 2-year high, so that is putting some pressure on prices. And on the other side, you had some Chinese data to react to today. While the services PMI was on a stronger note, but the overall PMI numbers did not excite the street. So it was lesser than the previous month and lower than what the street was anticipating as well. I want to start with precious metals because 2024 was a great year. We did see 22% gains for silver and 28% for gold. And this year as well, for 2025, the last 5 or 6 days, the momentum has just about continued and we've seen money flowing in precious metals there. The base metal that seems to be doing well is the copper prices. Remember, for fourth quarter of 2024, we saw the copper prices decline by 10%. It even went down to a 9-month lows. But the first week of 2025 has seen copper prices gain up by nearly 1.5% on the higher side. Well, the street is anticipating that you will see more stimulus measures coming in from China. Of course, much would also depend on the buying interest, especially after 20th of Jan, on how the world changes. Is something that's keeping the markets jittery. But at this point in time, the copper prices are starting 2025 on a stronger note. And this is even as the dollar index is trading at a 2-year highs. What is not doing well is the other base metal prices. So when you look at zinc, which gained 13% in last year, has started 2025 3% on the lower side. Aluminum gained 6% in 2024, is 2.5% on the weaker side. Steel and iron ore prices fell in the previous year and have started this year as well on a weaker note, awaiting on what China would really do. I want to take you to the iron ore prices because we saw nearly 25% of decline in the previous year. We are down by 4% for this one in this year as well. It's trading at a 3-month lows. $100 a ton has broken on the lower side there. Rising inventories, weak Chinese data, all of that seems to be bothering. But what is important to watch in this week is really going to be the jobs data, employment data from US. And apart from that, there are various speeches from US Fed officials that would keep the markets choppy as well. Okay, all right, Manisha got it. Choppy it is for commodities and choppy it is for equities as well this morning, actually. The good news for the bulls is the fact that there is some recovery from the immediate lows that we were sitting on. And the recovery is happening thanks to some buying on consumer stocks, select consumer stocks, and select BFSI as well as IT names. Speaking of consumer, let's look at the trends that are outlined in the third quarter print. And the stocks are really moving. So you have pizza and lipstick, which is moving higher. I'm talking about Nykaa and Jubilant Foods. But the staples, Dabur, Marico, these stocks are still under pressure. Let's go across to Mangalam to get a quick heads up again on those numbers. Mangalam.
Well, pizza lipstick doing well tells you about, the schism that we're seeing in consumer sector while staples are not doing as well. So you have a very, very strong update coming in from Jubilant Foodworks. The consolidated revenue grew 56%. Optically, this looks very strong. But remember, consolidated revenue includes the acquisition of DP Eurasia as well. The number to watch out for is the standalone revenue. There too, it's a 19% growth that the company has reported. And that is led by higher like-for-like growth coming in from Domino's India itself. And they've opened 60 net stores as well. So all these factors working well for them. The important thing we need to watch out for is the like-for-like growth in delivery versus dine-in. Because over the last few quarters, we had seen dine-in decline even as delivery was starting to pick up. So has there been an arrest in dine-in now, the decline out there? Secondly, we'll watch out for the impact on gross margins on account of beverage portfolio changes. Remember, ever since the Bhartiya family went ahead and bought HCCB, they did do a tie-up with Jubilant Foodworks to sell Coca-Cola as well as against Pepsi in the Domino's store. So does that come at a higher gross margin or not? And the third thing we'll watch out for, the growth in their other franchise, which is Popeyes. So that's a couple of things that we'll have to watch out for Jubilant Foodworks. For Nykaa, we did speak to Anchit Nair a couple of days ago on our channel itself when they released their beauty trends report. There they said that net revenue growth will be higher than mid-20s in the third quarter. But importantly, the beauty business is doing a lot better. The growth has accelerated out there. And, this time around, it will be above mid-20s and the gross merchandise value in the beauty business will be in low 30s itself. So it's a good update coming in a sector which was earlier looking for some growth coming by. Fashion business as well for them, which was earlier supposed to be a growth driver, is struggling a little. But there too, we've seen about 20% revenue growth, which is subdued, but the street expects this to improve as consumer sentiment improves as well. Speaking about consumer sentiment, not much improvement in general trade is what we've seen. Dabur had called out this weakness earlier, and that's what's reflecting in their performance this time around as well. But if you look at Marico, the overall revenue growth of the company would be in mid-teens. What's worrying the street right now is that this revenue growth is largely price-led, and there could be some margin-related impact, which the company has called out in their third quarter update as well, where the gross margins have actually fallen a little more than expected.
Thank you for that, update, exhaustive update. It's now over to Abhishek for Union Bank.
Well, Rima, I don't remember the last time for a sustained period of, let's say, 2 to 4 quarters that Union Bank of India did gain market share. Very weak business momentum coming in over there. A deposit growth at 3.8% YOY, decline of 2% sequentially. In that, the domestic deposit growth is just 2.5% YOY and a decline of, around 2.4% sequentially. Advances growth is close to 6% YOY and 2.2% sequentially. In that, the domestic advances have grown by 5.3% YOY and 2% quarter-on-quarter. The domestic RAM, that is retail, agri as well as MSME, which has been the focus area of all the lenders, that is up only 6% YOY and has declined by 1.5% sequentially. So a weak business update is being factored in the stock price in trade today. Back to you.
Okay, indeed, and Union Bank is leading the entire PSU banking pack down with it, but the numbers on deposits probably the weakest for Union Bank. Thank you for that, Abhishek. Very quickly, back to Mangalam to wrap this up. ITC, the demerger of the hotels business finally happening. Mangalam,
yes,
the price is on the screen now.
The price is on the screen right now, and if you compare the opening price to the previous close on ITC, it would be a difference of around 26, 27 rupees, which is slightly higher than what the street was anticipating. You know, more on the street, we're working with a number of anywhere between 15 to 20 rupees per share of the hotels business, and now the stock price is correcting to that as well. So it will be very interesting to see how the hotels business lists now sometime in mid-Fed. The stock opened lower by 26 rupees per share. That implies that the hotel business could be valued at close to 54,000 just basis the stock price move. The real, proof of what the hotel business is valued at will be when the hotel business lists in mid-Feb itself. But once again, to, jog your memory on the hotel business, first half of this year, revenues were closer to 1,500 odd crores with 28% margins, assuming they do 4,400 crores revenue by FY26 with close to 1,450 crore in terms of EBITDA. Valuing it anywhere between 26 to 28 times, which is a discount to Indian hotels and a premium to all the other players. This could be worth nearly 175 to 190 rupees per share. But the street believes, basis the price difference right now, it could be valued at a little higher. But the proof of that will lie in when the hotel business lists.
Okay, all right, Mangalam, thank you very much for that. With that, we have to slip into a quick break. On the other side, our special segment, It's the Economy. Lata today will be in conversation with Shantanu Chakrabarti of BNP Paribas to discuss what the early advances in deposits growth data indicate about the Q3 performance that can be expected from banks.